Welcome to the Everything Financial Radio program. I'm your host, Dennis Tubbergen. I am here every week at this time. I'm sure I'm glad you decided to tune in today. I have a terrific show lined up for you. My special guest expert today, you may have seen on CNBC or Fox News as an economic commentator. I'm very pleased to have Mr. Peter Schiff joining me today on the program. We'll get to my conversation that I had this past week with Mr. Schiff here in just a couple minutes. Also on today's program, Greece has a deepening depression. A report issued this past week projects that Greek unemployment will reach more than 30%. 76% of Americans are now living paycheck to paycheck, according to a CNN Money article. We'll talk about that. And the CEO of Ford Motor Company, Alan Mulally, this past week, engaged in a little name-calling. Said Japan, the country of Japan, was a currency manipulator. And interestingly, if you had purchased an original Apple I computer back in 1976 for $666, you may have something worth between $500,000 and $671,000 today. A lot of money for a computer with no case, but we'll talk about that. Also, with the fourth coming up this week, I'm going to leave you on today's program with some words of wisdom, I would say, from one of our founding fathers, Mr. Thomas Jefferson. So, terrific show lined up for you this week. Let me remind you that if you'd like to listen to any of the interviews that I conduct with our guest experts, you can go to the iTunes store and just search under Everything Financial Radio. You can get the shows for free, download them, listen to them as many times as you'd like, whenever you'd like. You could also go to everythingfinancialradio.com, where we have archived all my past interviews with guest experts. And I'd also like to remind you that we are conducting this summer one more class, our new retirement rules class, which has been very popular. You can get more information by going to newretirementrules.com. You can register there also as long as space remains. We'll be starting a new class on July 11th. We will continue that for 3 consecutive nights, 3 consecutive Thursday nights. The cost for the class is just $49, which covers the cost of all books and handouts. This is purely education. We talk in the class about current debt levels. We talk about demographics. We talk about the economic seasons. And we talk about specific strategies that you might want to consider depending on your situation as we go through what we believe is a current economic winter season. So, again, the website, newretirementrules.com. You can get more information there, or you can register while capacity remains. I am pleased to have back on the program with me today returning guest, Mr. Peter Schiff. Peter is a best-selling author and economic commentator. You've probably seen him on any number of television shows offering his perspective on the economy. And, Peter, it's a pleasure to have you back on the program. Welcome.
Oh, sure. Thanks for having me back on.
Peter, there's a lot of seemingly good news coming out regarding the economy, in particular housing. In fact, I was listening to a commentator this past week remark that housing is going to lead the economy to recovery. What's your take?
In fact, housing is going to lead the economy back into recession is a more likely scenario. This housing recovery is not real. It is a bear market rally, a dead cat bounce that was engineered by the Fed. And Ben Bernanke doesn't even recognize that, but that's what it was. I mean, if you look at the buying that came into the housing market, it was driven by hedge funds and private equity funds that were buying up houses, just like they were buying up junk bonds. But the markets are now collapsing. But now that interest rates are rising and that people are worried about the Fed taking away the punch bowl, the bottom is dropping out of these markets. So I think the speculators are in trouble with these houses that they bought. I think they were planning on securitizing them and selling them as REITs, but I don't think there's a market for that anymore. So I think the speculative buyers are going to be out of the market now. I don't think they're going to be there this summer. In fact, if anything, I think some of the spec money is going to be looking to sell the houses and make it, just cash in on whatever profits they think they have because they no longer have an exit strategy. And mortgage rates have now moved up from 3.25%, where they were for about a year, 3.25%, 3.33%. They're now at 4.5% and rising. My expectation is that we'll top 5% soon, maybe get close to 6% even before the year end if the Fed doesn't reverse course. I don't think that the individual home buyer can afford those types of mortgage rates, given how high real estate prices still are. I know they're lower than they were at their peak of the bubble, but that's not a valid benchmark. Meanwhile, the cost of living has increased a lot since then, and there are a lot fewer people with jobs, and so I don't think these homes are affordable at those higher rates. In fact, just based on the movement that we've had thus far in mortgage rates and the increase we've had in prices, the typical house is about 30% more expensive in terms of monthly payments today than it was a year ago. I just don't see where the homeowner has the extra 30% income to afford to make those payments. So I think we're already going to see the market rolling over. The wealth effect is going to work in reverse. Now you're going to have speculators selling their houses, and I think a lot of the spec houses are going to be for rent. A lot of the houses that the speculators bought are going to be coming on the rental market, and that's also going to work to depress prices, because why buy when you have so many quality houses that you can rent for less money? So that's going to go down. I think also car sales, RV sales, boat sales, they're all going to fall because the secondary market for those types of loans, I think, is evaporating. A month ago, you can get a 20-year loan to buy an RV at 3.99%. A 20-year loan based on an asset that's worthless in 20 years. An RV, if you buy an RV for $200,000, in 5 years it's worth $100,000. Yet you could borrow to buy the $200,000 RV $160,000 at 3.99% and paid off over 20 years. I mean, these are crazily risky loans. The market was trying to get yield anywhere it could find it. Now it doesn't want that anymore. So I think the recovery is gone, and a lot of the recovery was based on consumer confidence. Well, that's going to go away too when the housing market goes back down, when the stock market is falling, and a lot of individuals who were desperate to get yield. They took their money out of CDs and they bought bond funds or other leverage products, and they were getting 5% maybe returns. Those investments are down maybe 15% in the last month. So you take a retiree who had $1 million and he was living off the $50,000 a year income. Now his $1 million is down to $850,000, and he's scared because he just lost 3 years worth of income. And now he cashes out. He takes his loss, puts his money in the bank where he gets no yield. Where's he going to spend? Where's he going to get money to spend? So I think confidence is going to go, spending is going to go, and then we're headed into a serious recession. And if you remember, I was doing a lot of debating on CNBC and Fox back in mid-2008, and the subject was whether or not the U.S. was going to go into recession. And I was the only one that said yes. In fact, I was trying to say that I thought the recession had already begun. Everybody else I was debating with said, no, we won't have a recession. Maybe we'll have a little slowdown, but we're not going to get a recession. Meanwhile, the recession had started in December of 2007. So we were already deep in recession, yet all the experts didn't even think we were going to get to a recession. So I think these experts who are so optimistic, including Ben Bernanke, who has never gotten the U.S. economy right in his career, I think are all wrong again.
Peter, we've got just a couple of minutes left in this segment. If you're just joining us, we're talking to Mr. Peter Schiff. You mentioned that the Fed is talking about pulling the punch bowl away. I mean, at least maybe diminishing the amount of stimulus. Can they really do that? I mean, isn't the Fed now buying about 70% of new U.S. government debt? Who's going to buy it?
Yeah, they can't do it. I mean, we've already seen a small taste. Just him talking about the possibility of him removing the stimulus in the future, and the bond market's collapsed, and it's going to keep falling, and the mortgage market has collapsed. So imagine what would happen to rates if the Fed actually did something. Because if you actually listen to what Ben Bernanke said, he didn't commit to doing anything. All of this taper talk is predicated on the U.S. economy doing as well as he thinks. He actually said if he's wrong, which is far more likely than him being right because he's never been right, if he's wrong, he's just as prepared to increase the size of QE as taper it off. But it seems to me that this bubble was so big that the mere mention of a pin that might exist in the future pricked it. And now the damage has been done, and I think the only thing that Ben Bernanke can do now is to publicly come out and take tapering off the table 100% and commit to stimulus than we have now. To come up with a guns blazing and say we're going from $85 billion a month to $125 billion a month or something like that. Now, the Fed shouldn't do that. That's the wrong thing to do, but I think they will do that because it's the only way to maintain the phony recovery. You know, you've got a drug addict that's going into withdrawal, and you want to stop that. You know, you got to get them high again, and that's what the Fed is going to do, I think.
Well, we are chatting with Mr. Peter Schiff, and we will continue our conversation with him in the next segment when Everything Financial Radio returns. Stay with us.